This is the time to get out. Everybody is sitting down. They're really trying to sit idle maybe. They want to wait to see what's going to happen. I think this is where you get out. If you're looking to buy that first home, if you're looking to refinance, I think you go ahead and get the process started. You may find that there's some really good deals because there's less activity in this short window that we have right now from a few weeks ago. And I think that you will see that there will be greater activity a few weeks from now, maybe going into the true spring and summer months.
Before the coronavirus and social distancing impacted the economy like we've seen in the last few weeks, the big talk in the financial world was all about interest rates. And with the Fed cutting interest rates on Sunday night, there's still discussion around what it means for your mortgage. So, with mortgages and interest rates being one of the hot topics going around this week, we decided to bring back Making Your Money Work and started off with Bill Lane from Southern Trust Mortgage. We're going to dive into just what the interest rates are, how you can get started if you're looking at getting a mortgage, and everything mortgages you could want to know. So, without further ado, here's Bill Lane from Southern Trust Mortgage on the Making Your Money Work podcast. This edition of the Making Your Money Work podcast, we're going to talk all things interest rates, mortgages with senior team mortgage loan officer from Southern Trust Mortgage, Bill Lane. Bill, really appreciate you taking some time on this beautiful day to talk to us, even though not everybody's getting outside. We're going to jump into it. There's been a lot of talk about interest rates, about mortgages over the last few weeks with the way things are going. If you had to kind of break things down for what's happened to interest rates and what that means for people's mortgages, how would you do that to kind of somebody that doesn't necessarily know what's going on?
Well, first of all, we've had a really good run. I mean, the last 3 or 4 years has been a very soft, I think maybe the best way to explain it, it's been a feathering down in rates. And with that, we got kind of lulled into a sense of everything's going to continue to go down and never stop. We had a little bit of a eye-opener about 2 weeks ago. Monday, March 9th, about 10 a.m., everything started pushing rates up. Whatever they might have been, the market was having its own issues. Typically, that would push rates down. But our rates continued to go up. And between Monday, March 9th, and that Friday, for those 4 or 5 days, we literally saw rates go up about 1% to 1.25% relative to where you would have been on your particular program that Monday morning. Now, that may not be the norm, but I think that was a reaction to everything that's going on right now in the world. It's not so much financial at this point. We all know there's a virus. We all know there's instability, there's concerns. Nobody knows what's going to be around the corner. So I think a lot of people and the Wall Street markets that buy these mortgage-backed securities just got to a point where they didn't know how much more they could handle. And they wanted to, I don't want to say artificially, but they did not necessarily want the rates to go down any further because they couldn't handle what was coming into the pipeline. Now, if that's the case, then we have kind of plateaued. And we are expecting that even though we are where we are and the rates are still great, they're excellent. When you're talking about high 3s and low 4s, everybody was happy about that. When you started talking about high 2s and low 3s, of course, people were more happy about that. We're in a great market. We can accomplish a lot. You can have an incredible mortgage. And at this point, if we don't get better in the short term, even at that, if you're at 3.75%, 4.25%, whatever it might be, if we do have a potential leg down again, and we find ourselves in an interest rate that nobody ever expected. I've been doing this 25 years, and the rates that we saw prior to March 9th were as low as I've ever seen. So if we get back there, you may actually have an opportunity to potentially refinance if you've been in your mortgage for 6, 7, 8 payments. So there's a lot of uncertainty, but we don't necessarily want to tie our, I don't know, for lack of a better word, our anxieties about what's going on in the world, what's going on in the stock market, to your home purchase. This is the time to get out. Everybody is sitting down. They're really trying to sit idle maybe. They want to wait to see what's going to happen. I think this is where you get out. If you're looking to buy that first home, if you're looking to refinance, I think you go ahead and get the process started. You may find that there's some really good deals because there's less activity in this short window that we have right now from a few weeks ago. And I think that you will see that there will be greater activity a few weeks from now, maybe going into the true spring and summer months. because we had somewhat of a false spring, so to speak, in our industry. We usually are relatively quiet in January and February, and our February was like a typical July. So I think right now, this would be the time where everybody stops and realizes this is where we are. The sky has not fallen. We're in great rates, and getting yourself situated, do a little bit of work up front, talk to your loan officer, get that information in so you can strike when it does come down, if it does come down.
And just for kind of a comparison, when you talk about what the rates hitting as low as they were over your time, what was kind of that average rate that you've seen that's kind of that people have been getting before this huge drop we saw leading up to March 9?
Well, I started 25 years ago and it was 8.5, and it has been a steady downward trickle ever since. And people were absolutely beside themselves when we broke 6%, and then when we broke 5, and we broke 4. We hit 3% back in 2012 for a very, very brief window. And that's why it's important to not necessarily get lulled into a sense of it's going to continue going down. I want to wait. I do have some clients that maybe waited a day or two too long, and that opportunity they were looking for pulled away from them. Now, hopefully it does come back. But I would say that in the last 4 or 5 years, being between 4 and 5.25 has pretty much been the norm. Now, every program is a little bit different. Every bar is a little bit different because there are criteria that come into your specific rate, be it credit score or loan to value, program type, whatever the case may be. But yeah, we are right now where we are is on the lower end of where the norm has been for the last 4 or 5 years. So it's still excellent.
And you touched on it a little bit with, how kind of slow things are right now. But as you look, obviously, with the uncertainty, you never know what's going to happen. But as you look forward, do you expect these rates to kind of stay lower? Do you expect to see them maybe climb back up a little ways as we jump out of this coronavirus lull?
So I think the first misunderstanding, or the biggest misunderstanding recently, is the Fed cut. So if you paid attention, you saw that Sunday night of all times, the Fed came in and made an unprecedented and very large cut to the Fed rate. And it brought us to relative 0%. So you can imagine that night and Monday and Tuesday and so far this week, I've had a lot of calls, a lot of texts. I want to get that 0% mortgage, whatever the case may be. It's important that the average person that's going in potentially doing something with a mortgage understands that when the Fed makes a move on the rate, it affects themselves. So it's short-term money. And those aspects of your life that are tied to short-term money might be credit cards, car loans potentially, and even, on a mortgage side, adjustable rate mortgages become in favor when it comes into a market like this because they're tied to, even though they're spread out over 30 years, they're tied to maybe a 5-year fixed rate mortgage or a 7-year. That kind of falls in that category. So they didn't get hurt. They actually maybe improved a little bit, but that's not your mortgage rate. Now, there is the expectation that there'll be a ripple effect. But when the Fed cuts the rate like that, the mortgage industry was preparing itself for it. Now, that was an unprecedented, again, very large rate cut. But typically you'll see rates kind of spike even a little bit more right after a Fed cut like that. And that's kind of what we've seen so far this week. Nothing like what we saw the week of the 9th, but we have seen a little bit of a deterioration again, kind of negligible, but it has not improved so much. I think that what you'll see is as it settles, then going into, I'm seeing it happen a little bit today. My guess is maybe next week you're going to start seeing some softening because we really have to have housing. Housing is the backbone of your whole economy when it comes to, at least in this country. And they're going to have a vehicle and a environment where borrowers and buyers are anxious to want to get out there because that drives everybody back to a happy place. So I think that we're going to see right now, we're in the middle of March. I think that your end of April and your May, June, July, I think they're going to be great opportunities. And that's, again, why you really want to get yourself situated now and take care of your paperwork. Because when that great opportunity happens, it's going to be a mad dash. There's going to be properties that are going to be under contract within minutes, if not hours. And you're going to need to be prepared to be able to give a letter. And that's why it's important to be situated with your lender.
Since you've mentioned it a couple of times, let's go into the process for someone, say, who hasn't owned a house before, who's, looking to go out there, get that first house. Once they get out of the apartment now, what's the process for someone as they look to get, what are the steps they need to take as they look to get that first mortgage?
Well, it is 2020. So the antiquated way is to come in, sit down with your mortgage loan officer, have that face-to-face talk, and spend an hour and a half of your life getting confused. Okay. The reality is to borrow large sums of money, and will be in all likelihood the largest money transaction most people go through. So we have to look at certain things. We know that. We got to look at credit. We have to look at stability of income. We have to look at the income itself, look at your debt structure, and we pull it all together. So it's the same for just about every program. If you go back 15 years ago, before the mortgage meltdown that we had back in 07, 08, it was a little bit maverick. We had programs where we really didn't concern ourselves too much with some of the qualifications. That's not the case. So if I was getting prepared and wanted to talk to a loan officer, first and foremost, in my situation, it's all handled very simply. You don't have to leave your family. You don't have to leave your office. You don't have to leave the things you enjoy. You can literally do it from your phone, and all can be pulled, and I can do it within an hour, half hour in some cases if it's really urgent. But you want to make sure that you have your most recent pay stubs, maybe your W-2 from 2019 available. If you have any aspects to your income that are tied to maybe some business ventures, or if you own some investment properties already, then you might want to have your last 2 years tax returns, because that could come into play. Your assets, which are your bank accounts, maybe your investment funds or a retirement account, current statements on those. Simple enough, you should be able to pull those offline. And as far as the actual loan application itself, a link can be sent to you from any lender, and from your phone you can go in. You are protecting your credit authorization at that point, because you're the one putting in your social security number, your birthday, your personal information. That way, if there's anything that's transposed by your lender when they go to order your credit report, it doesn't come back to haunt you for years. They can be very sensitive in that respect. So to take the few minutes to literally go in, take care of the app, drop in. In my case, after you do the online application, I provide you with a personal transaction tool, and it's a link that connects you directly to your loan. So from your phone or from your laptop, you can drop in PDFs. You can use the camera on your phone to take a picture of your driver's license, drop it right into your loan, 100% secure. We can have everything we need and push you through priority approval within 24 hours. So technology in 2020, if you're not working with a lender that can really provide you that convenience, you may want to make a couple different calls.
What are some of the biggest kind of wrong ideas or misconceptions you see people come in with when they're looking at getting that mortgage and getting pre-approved?
I think the first one is right off the bat, just wanting to talk to a loan officer, and I want to know what my rate is because I'm shopping. And as a consumer, you have that need. You need to know you're getting a good deal. So a loan officer by law cannot give you a rate quote over the phone and cannot provide a rate quote without a credit report. So when you're talking to a loan officer, the biggest misconception is what they say that moment is it. So you call me and I tell you 3.75%, no points. You call the next lender, they tell you 3.5, no points. We don't know what's going to happen. The market has been moving it's been so volatile that you can have rate changes every hour, much less every day. So that first call and relying on that first quote, or just at least that first conversation, I think that the main thing you want to look at is, first of all, is this lender going to be able to come through for me? Who referred me to this lender? Are they professional? Why did they refer me to this lender? You have a lot of large institutions that can provide lending, and we're all selling the same money when it comes to mortgage. But it's also, can you talk to this lender Sunday afternoon at 4 o'clock? Can you reach them? Can you text them, email them? Can you call them specifically on questions that you have that moment? Are you going to get that from the lender that you're talking to? Are you going to have a specific loan officer? How are they quoting things? How are they handling my documentation? All that. I think the biggest misconception is you're going to get everything you need from that first phone call, and that's not the case. The truth of the matter is, borrowing large sums of money takes a lot of work between you and your lender. You've got to play the game. They're going to have questions that come up after you provide the initial list of needs information, be it a large deposit needs to be verified and understood better, or your employment doesn't fully cover 2 years. We need to add something new. There's going to be a relationship that's going to exist. But the more you take care of it up front and get it taken care of and roll your sleeves up and try to get to that point where it's all done, the easier the actual purchase side of the transaction is going to be when you can focus on getting your family, your furniture into a new home, new school systems, whatever the case may be. Your money is already set.
We touched a little bit on the rates. And so another hot topic has been, refinancing with the way the rates have been. If somebody comes to you and says, Bill, should I be refinancing right now? What are kind of the first things that you look at and the steps you advise that person to take?
So one of the first misconceptions with refinancing is I shouldn't do this unless I can drop 2%. Well, I have people right now that are at 3 7/8 and 4% on a VA mortgage that have had success refinancing down when we hit the bottom to 2 3/4% on their special VA type of refinance. No cash out of pocket, no concerns, but it worked for them. They broke even in less than 3 years. They know they're going to stay in this home for more than 3 years. It worked. They didn't need to wait for 2% or they would have lost a great opportunity. So I think that's one of the first misconceptions. And a lot of the older generation, that's what we talked about back when I first got in the business. So parents and family members and neighbors, they may tell people 2% is the rule of thumb, and people leave, they leave a good opportunity on the table. The second thing is, do you need to bring money to the table? You should not. Any refinance should have enough equity in it and should be set up to allow for the cost of the loan to be secured in the new loan. So when you're refinancing, if you start out with $250,000 loan and your end loan is $260,000, one of the things that we really have to explain is in that refinance are your closing costs. It's just like buying a car. You have tags, title, insurance as any major purchase, and you've already bought the home once, so you've been through that. You've seen that if your refi program requires an appraisal, we got to pay an appraiser. It's a couple $100 there, and you have title insurances that have to be updated and settlement fees, and they all should be at a reduced rate. We call them a reissue premium. But you'll also see that your escrows are being rolled into that loan as well. Your real estate taxes and homeowners insurance. Well, that's not a true cost for refinancing. You're going to be paying real estate taxes and insurance forever, as long as you own a home. Refinancing doesn't change that. It's just required in the new loan to set those up again, just like we did when you bought the home. So what will take place is you will close on your refinance, and within about 3 weeks, the loan that we pay off, the current loan that no longer has a need for your escrow account, will send you a check for whatever's in that escrow account, which you can look at and see at any time, and that money is yours. So that's not a cost. So hypothetically, if you see a $7,000 increase from what your loan is today to what the new loan is going to be, you really need to talk to your lender and ask them how much of it is the prepaids, how much is truly the closing cost. Look at what your savings. If you're saving $100 and your closing costs end up being $4,000, that means in 40 months you will break even, and after 40 months you will be $100 better than you are today before refinancing.
Wrapping up with Bill Lane, your tips to someone who's looking, kind of been watching the interest rates, wanting to either buy a house or refinance. Your tips to someone who's kind of sitting at home looking at that, thinking about that right now.
So the single best tip I can give anybody that's sitting home right now, interested in taking advantage of the opportunities when they come up, get a lender, take care of the documentation, get in the system. We will get you pre-approved as a to be determined property. That will have you in a catbird seat. We can send you a pre-approval letter immediately. It puts you at an advantage against the competition when you might be going up against other contract offers on a home. So I would take care of your lending now. It can stay in the system with us for months. It's okay. We'll keep you informed. Take care of it now, get your information in, get your documentation in, and be set. That's my best advice for you.
Bill Lane, thanks so much.
Thank you. I appreciate your time.
Now, if you enjoyed this episode as much as I did, make sure to click that subscribe button and leave a rating and let us know how we're doing, what we can do to help you, and what topics you want to hear. Additionally, if there's someone you think would be a great interview for the podcast, make sure to follow us on social media and let us know. We at Sqwire are here to help you, so don't be afraid to reach out no matter what question or issue you're running into. We look forward to hearing from you and talking to you on social media.